In this video, we're going to talk about the Williams percent R indicator. Stay tuned. Hey traders, a very warm welcome to you. So what is the Williams percent R momentum indicator? And most importantly, how can we use it in our trading? Well, do you know what? It's identical in shape to a fast stochastic. I've got a Williams percent R up here. Let me stick up a stochastic and let me show you. So if you're familiar with a stochastic, then you're going to be familiar with a Williams percent R. Look at the fast line here on the stochastic, identical to this Williams percent R line. The only difference is the way it's calculated is slightly different, and it has to be normalized by multiplying it by minus 100. So instead of ranging from 0 to 100, like a stochastic would be, it's ranging from 0 to minus 100. So for all intents and purposes, guys, it's identical. All you got to do is kind of remember in your head what the reading means relative to the stochastic, which you may well be familiar with. So anyway, as it's very similar to a stochastic, let's have a look at some ways that we could implement it in our trading. So let's go to something like US dollar Swiss, and let's talk about it. So general thing is with these oscillators, guys, is they go from a high point to a low point, and the whole theory behind these is to indicate an overbought or an oversold condition. So in other words, as price goes above minus 20, in other words between 0 and minus 20, that's considered as overbought, and as price moves below minus 80, in other words between minus 80 and 100, it's considered oversold. And this default setting here on TradingView has given us a shaded area. Now I would like to go one step further with this. Let me just clear off those things, and I would like to go one step further and add a mean. I like adding means to things because it just gives you an idea, a benchmark of where it sort of should be under normal conditions. So there we go, there's our mean. Minus 50 would obviously be a midpoint for us on this percent R indicator. So the theory is obviously with these kind of oscillators that you're going short when you're in an overbought condition, or you're selling your long, and you're going long when you're in an oversold condition. Oversold condition. And that works very well in a range bound environment. You can look here on the Swiss, we've got an overbought condition here, short, lovely. We've got an oversold condition here, so you're long, lovely. This is a daily chart, by the way. You're long, lovely. Everything looks very nice and crispy and beautiful and profitable in a nice range bound environment. Every single trade on this in this past month would have been profitable, and that's why they are so powerful in a range bound environment. Look at this this overbought condition here. Same kind of thing, guys. You can see, you get the idea. Overbought, you're going short. Oversold, you're going long. Beautiful range bound trading. That is exactly the kind of tool you want to be using. However, we know real world it's not always like that. So what other ways can we use this kind of tool? Another way of using it is buying a first pullback on the oscillator when we're in an uptrend. So let's move into something like Dow, US 30. I've got a CFD adjusted chart here, cash adjusted chart. Let's get rid of some of this stuff on here and let's talk about it fresh. So we have, a good uptrend. We had a nice solid uptrend. Let's say we've started the uptrend from around here. Let me drag it back for you so we can see. Let's say we started the uptrend around here. Let's say we weren't savvy enough to get on it on the initial drive up. One caveat, guys, before we move on, and I should have mentioned this, but I guess it's clear to you if you've traded with stochastic before. You've got to be careful in a trending environment just hitting it straight away oversold, because markets can stay overbought or oversold for a long time. Look at this Dow here, it's gone overbought and it's stayed overbought for kind of 2 months, and it's risen from 18,500 all the way up to 20,000 before it finally broke below that overbought level. So be very cautious about that. If you're going to trade the previous example, we talked about overbought and oversold, wait for the cross to come in and kind of use that as a judgment. Anyway, so let's say the market's pushed up or in an uptrend. What we're looking for is the first cross below 0 and then a cross back up to buy. Now, sorry, not 0, below oversold. In other words, I've got this at minus 80. So as it crosses below that, we're looking to buy for continuation. So it's the first kind of unwinding on the trend. So we'd be buying around here, we'd be buying probably around here, and we're looking to come out as we push to new highs, or as we cross back below that overbought condition. So wait till we come into overbought and cross back below it or something like that. Now obviously this I've just picked this example here, that's only going to be a kind of a little sneaky. How much have we got there? It's not a bad trade, is it? I think you're probably looking at around 250, maybe 400 point move on that. Not bad, but that's the idea. I've not really kind of taken time to pick the very best one for you guys, but you've got the idea. The push up, the pullback or consolidation is going to cause that percentage R to go into an oversold condition, and then your idea is you're buying it as momentum starts to push back into the market again and give you that drive. Obviously, we've got the similar things with divergences as well. If we're pushing to new highs and we don't have a new high level and things like that in our momentum indicator, percent R Williams indicator, then we could use that as a signal that maybe we want to be careful that things might be running out of puff a little bit. So it's quite a versatile, useful indicator. Most powerful in a range band environment. If you've got something that's ranging, chopping around, just not quite sure, indecision, beautiful tool. Overbought, oversold, wait for the crosses, short on the cross down below, long on the cross above. I like to kind of frame things as well by adding this midpoint, as I say, at -50, so you can maybe think about scaling stuff out. And also, don't forget, when you're in a really brutal uptrend or really brutal downtrend, you might not get a cross down into oversold against the grain. You might just get a cross down below that midpoint level. So if you're extra aggressive, you can use that midpoint level and say, okay, I'll wait for a cross below the midpoint and a cross back above before I get involved. It's going to get me involved a little bit earlier, but it's going to at least make sure I'm on an earlier move that's only consolidating a little bit as opposed to pulling right back into oversold conditions. Anyway, guys, that's Williams percentage R. Hope you learned something and enjoyed the video. Take care. Good trading. See you in the next one. Bye bye.